Continuing to move forward, we're going to talk a little bit about the reporting of cash and some of the real basic principles of cash management. Remember, a lot of these are the foundational principles. They're not the end-all be-all. Cash is reported in two different statements. There's the balance sheet, and then there's the statement of cash flows. Cash can consist of coins, currency, checks, money orders, and money on hand or on deposit in a bank or a similar depository. The balance sheet is going to show the amount of cash available at a given point in time. The statement of cash flows, though, is going to show the sources and uses of cash during a period of time. So the cash on hand may include our cash and our cash equivalents. So cash equivalents in reporting cash are short-term, highly liquid investments that are both readily convertible to known amounts of cash and so close to their maturity that their market value is pretty insensitive to any changes in interest rates. Restricted cash is cash that is generally not available for basic use. It's restricted to a very specific purpose. Restricted cash should be reported separately on the balance sheet as restricted cash. And if it's expected to be used within the next year, the amount should be reported as a current asset. If this is not the case, then the restricted funds would be reported as a non-current asset. Now, while it's possible, but it should absolutely be rare, is when a negative balance occurs in the cash account. If that happens, then it should be reported among the current liabilities versus a negative balance on an asset. So here we're showing just kind of the basic balance sheet showing the cash and cash equivalents. So typically they are wrapped up together and reported in one amount and are comprised of many different types of cash, from different bank accounts to the petty cash fund to those really highly liquid short-term investments. They could be mutual funds. And you notice here how restricted cash is kicked out and denoted separately. I want you to take a second. I want you to identify whether each of these is true or false. And one of the biggest struggles a company has is the managing and monitoring of cash. And Companies struggle not because they fail to generate sales, but because they can't manage actual cash. Managing the precarious balance created by the ebb and flow of cash during an operating cycle is one of the greatest challenges a company has. So think about the operating cycle. That's the point from cash to cash. So we buy the inventory, we receive the inventory and pay for it, we sell the inventory, we generate an accounts receivable, we have to receive the cash from the accounts receivable before the operating cycle completes. Companies can improve their chances of having adequate cash by following some basic principles of cash management. And this is where some small companies really have a weakness. You can increase the speed of your receivables collection. So the more quickly customers pay the money, the more quickly a company can use those funds again to generate more sales. Any attempt to force customers to pay earlier must be carefully weighed against the possibility of angering or alienating your customers. And one common way that we do use to encourage customers to pay more quickly is cash discounts for early payment. Keep your inventory levels as low as possible. So keeping large inventories ties up large amounts of cash. It also ties up a lot of warehouse space, which you're paying for. Many firms are using techniques to reduce their inventory on hand and to conserve their cash. So maybe practicing just-in-time inventory management. But this is a very intricate thing that has to be carried out. There is a tipping point. You don't want to not have inventory, but you don't want to have too much. So there's a lot of science that goes into determining the correct inventory amounts at the correct points in time, especially for those companies that are seasonal in nature. You can monitor your payment of your liabilities, and you should use the full payment period but not pay late. You don't want to damage your credit rating. Another thing that late payments can do is that it can damage your vendor or supplier relationship. So you want to carry it out just as far as you can without causing any damage. And then looking ahead and planning the timing of major expenditures. So in order to increase the likelihood of obtaining outside financing, companies should carefully consider the timing in light of their operating cycles. If at all possible, the expenditure should be made when the company normally has excess cash, which is usually during an off season. And then when you have idle cash, invest it, because just cash on hand is earning nothing. An important part of the job of the treasurer is to ensure that any excess cash is invested, even if it's only overnight and you're only getting pennies. A liquid investment is one with a market in which someone is always willing to buy or sell the investment. And a risk-free investment means that there's no concern that the party will default on its promise to pay its principal and interest. So with this in hand, these are some basics to cash management. These are things that should be occurring at all companies, but areas where a lot of companies really struggle, whether it's the looking ahead, or it's the payment of the liabilities, or it's having large amounts of inventory, tying up your cash. These are areas where companies can constantly revisit and they can constantly improve. So some of the things that companies do to determine what their cash flows are is a cash budget. So this is going to show the anticipated cash flows over a 1 to a 2 year period. The farther out you get, the less accurate it's going to be. It's going to have 3 sections. Your cash receipts, which is going to include your expected receipts from customers, from the company's primary sources of revenue, such as your customers and cash sales, collection from customers on credit sales. It's also going to show anticipated receipts of interest and dividends based off your cash management policy, and any proceeds from your planned investment sales or plant assets or issuances of company stock. It's going to have the cash disbursement section, which is going to show the expected payments for things like your inventory, your labor, overhead, your selling and administrative expenses. It's also going to show projected payments for income taxes, dividends, investments, and the plant assets that you're going to invest in. And then a financing section, which is going to show what you expect to borrow, and then the repayment of those borrowed funds plus interests. A cash budget contributes to more effective cash management because it can show when a company will need additional financing because of short funds, or when a company is going to have excess cash that they can have available to make investments. Here we have an illustrated cash budget, not real detailed. The details in some of these, such as your selling and administrative expenses, would be in other schedules. You could go back to those to see what those various expenses are, how those salaries break down, but it rolls up into the cash budget.